What's up, everybody? Welcome back to my channel.
Earn it, save it, invest it.
I hope you're all having a great day. In this video, I asked ChatGPT, please give me a prediction on when you think the next recession will be based on historical data. We're going to go over what ChatGPT said and what are behind the numbers, and then we're going to see exactly should we expect a recession here soon in 2025, 2026, 2027? Who knows? But we're going to see exactly what ChatGPT says, and then we're going to go over why it said what it said. Before I break it down, please give a like and subscribe if you enjoy this content. It really helps me out trying to grow this channel. Just trying to give out some information. In no way am I trying to give financial advice. Everyone needs to do their own research. Even if you watch this and I give out plenty of information, you always want to do your own research before buying and doing anything. So, give it a like and subscribe if you like this content, and let's get into it now. So I asked ChatGPT, please give me a prediction on when you think the next recession will be based on historical data. ChatGPT said, based on historical patterns, recessions in the US have typically occurred every 7 to 10 years, although this cycle isn't always consistent. Given the last official recession in 2020, triggered by COVID 19, some analysts suggest that the next downturn could potentially emerge between 2025 and 2027 if economic cycles follow previous trends. However, factors like aggressive Federal Reserve rate hikes, persistent inflation concerns, and geopolitical instability could accelerate this timeline. Conversely, strong consumer spending, innovation driven growth, or effective monetary policy could delay a recession. While historical data can provide clues, the economy's complexity makes precise predictions highly uncertain. Keeping an eye on leading indicators like the yield curve, unemployment trends, and corporate debt levels can offer better guidance. So let's go over this really quick, right? Based on historical patterns, it happens every 7 to 10 years. So in that case, it's saying we officially had one in 2020, right? Well, let's go and look at the yield curve, right? Because that is one thing it did say, right? It said you want to be keeping an eye on the yield curve, unemployment trends, and corporate debt levels. Now, this is something that I saw with the yield curve. The yield curve right now, currently, the 2 year is still under the 10 year. Now, um, what when you ever hear of an inverted yield curve, it's basically when the 2 year is worth more than the 10 year. And the reason why that looks bad is that people think the very short term is more positive than the long term. So that's kind of an indicator of, hey, there's a recession coming on. But the 2 year right now is currently under the 10 year, so we haven't hit that inverted yield curve. Now, this is what it's been, the spread, right? The 2 year and the 10 year. And you can see every time it hits the red line, right, it says, okay, we have a recession that follows. The gray area is a recession. An inverted yield curve has predicted the past 7 recessions. ChatGPT, we had an official recession in 2020, but I think we had one in 2022. I mean, we went inverted yield curve, but no, we didn't officially announce it. And I remember getting, updates, doing my research, and just seeing the numbers and saying, we are technically in a recession, aren't we? But no one wanted to say it. They didn't want to officially announce it. But when you actually look at the yield curve, we're not doing very bad. We are right here at this level where it usually will indicate a recession, but it seems to kind of want to bounce more off that line rather than bounce to it and then bounce down, right? So, if anything, we could maybe bounce up. I have a feeling maybe, if anything, we could be bouncing back up. It would be very strange to see this, right? Are we going to go back to the 1980s where we just consistently stayed under and it was an inverted yield curve for many years? Um, I'm not exactly sure about that, but it doesn't look like we're doing horrible in that perspective. ChatGPT also said to check the unemployment rate. I'm sure you have heard Trump is now, making all kind of cuts to the government, Department of Education, Veterans Affairs. So right here it says Trump administration plans to cut 80,000 employees from Veterans Affairs, according to internal memo. So it hasn't officially happened, but what has happened is the U.S. Department of Education has been cut nearly in half. According to the announcement, more than 1,300 positions will be cut as a result of this reduction in force. Roughly another 600 employees accepted a voluntary resignations or retired over the last 2 months. So obviously, that they're cutting departments, they're cutting jobs, and that's something we need to keep an eye out for. Correct? So let's check out the unemployment rate. The unemployment rate, as you can see, over time has gone up and down, up and down, up and down. Now, with a lot of things, the stock market, it's kind of the opposite, right? When you have a bad time, right, in unemployment rate, the bad time is when it spikes up, right? The stock market is when it goes down. Usually, the moves down, the hurtful moves, the painful moves, the unemployment moves, the stock market crash move, they happen way faster than the recovery. If you just think about your bones, right? You break a bone. Is it faster to break the bone or to heal the bone? It's a lot faster to heal the bone, or a lot faster to break it than it is to heal it, right? The healing process takes a while. So as you can see, we've had spikes of unemployment from basically 1969 all the way to 1983. It was kind of, or 1982, yeah, 1983. It was, fairly bad. It just continued to go up and didn't really alleviate too much until it went back up. Ever since then, we've been kind of on our way back down. Great financial crisis shot us up. And then, of course, COVID shot us up as well. But you have to start thinking yourself, if it wasn't for COVID, when are we getting this next spike, right? You can see that there's not a lot of time in between okay, we have recovered and now we're spiking back up. Okay, all right, recovering, and now we're spiking back up. We're recovering. We're recovering for a very long time. This was, that's from the top over here all the way to COVID, 3,836. You're talking over 10 years, right? From '09 to 2020. So basically 11 years. And if it wasn't for COVID, right, and you look at the spike, now typically your way back down is like rolling down a hill, right? I feel like you're climbing a wall, but you roll down a hill, right? You climb a wall, but you roll down a hill. That's how all of the unemployment rate has been. You can see the spikes, right? The spike, but then we also went right back down. And it just doesn't feel like that's correct. Now I understand that this spike is also a little bit, you know, misconstrued because it was such a crazy event in the world. But again, let's say this never happened, the spike because when's our next spike? We have to have a spike of unemployment, right? It seems like here's a good line, 5.3, right? We're looking at a 5% unemployment rate. We're going to have to reach here soon. Who knows? Who knows? With all these budget cuts happening in the department or in the government and everything, we'll see. Also, the United States debt balance of credit cards, right? So we have $1.2 trillion in debt debt balance on credit cards. Now, as you can see, that is extremely high. It's 300, 400 million more than the Great Financial Crisis. We're jumping up here in COVID, and then it went down, and then boom, everyone just started paying on credit because people got into this money spending habit because the government shot money into the system, and then people just started spending on their credit cards. Now, though, right, personal spending, United States personal spending has dropped. As you can see, it's to the lowest levels since 2023, 2022, right? Since March 2023, and ever since then, it goes up and down, right? We're bouncing, right? It doesn't really go that far down. This was, again, COVID. Usually, whenever you look on stock charts or economic charts, you're always going to see a really exaggerated spike for COVID. But as you can see, there's not many times we get lower than this, right, of personal spending. So hopefully this is a point where maybe the Fed, it lowers interest rates, and then it helps people start to spend more. This is also, I feel like, a problem is the United States personal savings. I was looking at this chart, and it seems like ever since 1975, We have just been on a downtrend. We cannot have any personal savings. Things are getting more expensive faster than we're making money. So we're unable to save. And so you can see over the last 18,000 days, our personal savings has gone down 73%. Let's not, that was a spike. Let's say up here, right? Let's even say down here. Let's say over down right there, down 64% from the 1970s. How much were our parents were able to save and our grandparents were able to save, right? They were able to save a lot more than 64% because that's actually a negative, right? If you go the other way, if you go this way, they were able to save 183% more than us. The personal saving, and that's because, again, things are getting more expensive. The price of things is going up faster than our wage. United States bankruptcies, right? As you can see from when they've been keeping track of everything, it's been on a consistent downtrend. But the thing you want to look at is, when do you have an uptrend? And obviously we had a little bit right here, '05, right? And '06. And then we had a bunch, it dropped back down for some reason. I actually wouldn't even, I want to look into that. And then we skyrocket with bankruptcies, right? So I don't know exactly what caused the drop off right there and then the full push for bankruptcies. But then obviously that was a great financial crisis. And then we're coming back down, right? And then, of course, 2020, no one was filing for bankruptcy because everyone was getting free money from the government. But now 2022 came along, 2023, and the bankruptcies are going up. Now it does seem like it's kind of, the curve is kind of now like stabling off a little bit, but that is something to keep an eye on and see how many people are filing for bankruptcy, because if that spike continues to go up and push up, then we might have a problem in the economy. And then the last one that I have is a United States Consumer Confidence Index. Right now, we are not confident. We've been, it's been here in 2023 and 2022, which we were not very confident. And then we have 2011 and the great financial crisis. 2011, we thought there was going to be a double dip recession. So we were really not confident. 1990, the 80s, right? There's been very few times where we've been at this low levels of consumer confidence. People are not feeling confident about where their money, how far their money is getting them. And so people don't want to spend, right? You can see the personal spending is down, and people are not confident right now. So to kind of take away from everything, ChatGPT obviously is not going to predict the next recession. There's plenty of other indicators that you could say, hey, we're not going to be in a recession. Right? It said every 7 to 10 years. Well, if the last one was technically 2020, then, we still have maybe another 2 years. But it's the economy you can never really predict. So you just have to look at some numbers, kind of make your own decision. The people who make the most money, really, if you want to make guaranteed money, whether there's a recession or not, buy consistently. Buy every week, buy every month. So if there is a recession, if stock prices go down, you're buying at cheap prices. You're buying at a discounted price. Buy quality companies, of course. Don't buy crap companies, because those will continue to go down and they will have a way harder, recovery. So you want to buy real high quality companies, look into them, do your own research. I do my own research. I'm going to be posting more on my YouTube about the companies that I find, their numbers, why I think they're going to go up or go down, whatever it is. And yeah, do a lot of research before, but be consistent. Consistently buy throughout time. If you know anything about compounding interest, it literally is the exact opposite of timing the market. You want to have time in the market. Someone who puts $50,000 into a market will, in 15, 20 years, someone only has to put in like 1,700 or something like that and can make the same amount of money. And yeah, it takes 50 years, but they put in 25 times less, or more, 30 times less money in. So compounding interest really, really starts playing a part when you're in the market for a long time. and you don't want to go all in at one time. And I'll actually show you something really quick. This is why you don't want to go all in at one time. This is 1928. We have all this around. Now, of course, if you did go all in right here, you would have been up, right? You go all in here, you would have been up. You go all in here, you would have been up. But you would have been freaking out at the time that you went down, right? These downtrends, you would have been freaking out, right? From here all the way to here, you're talking 1972, all the way to 1982. 10 years it would have taken you to make your money back if you went all in at this time. But if you were buying consistently throughout this whole period, lowering your average, and buying good quality companies, you know, you would have made money. And you look over here, and this is one piece that I really, because this is more of my generation, is the 2000, right? The dot-com bubble. When you look at, if you would have gone all in 2000, it would have taken you 13 years to make your money back, right? But if you would have bought consistently throughout those years, and even bought throughout these years, and bought throughout, even if you buy less, just buy some. Buy some, because when you're buying down here, a little bit here, a little bit here, a little bit here, and then it grows up here, it offsets any kind of losses you would. It just, you got to be consistent. Buy, and you can say, oh, well, if I'm making less money, I'm being laid off, I'm doing this. That's why I'm saying you can buy less in these times, but have something automatic. I know people don't want to say, oh, I shouldn't have to give up a meal to save for it. This video, I don't want to speak as if, oh, we should just be taken care of, right? I don't believe people should be having to work two jobs to survive. I do believe we have an issue, but there's nothing that I can do personally to change any of that. I am not in politics. I am in no in position of power. So all I can do is try to help people who are powerless as me to get into a better position. And if you can give up a meal or two, right? And I know we've heard I know I have. I heard the article about some CEO of a food company saying, oh, poor people, in order to survive, they have cereal, right? They're having a bowl of cereal for a meal. And it's one of those, I'm not telling you, oh, you have to be eating bowls of cereal for dinner, but you have to think about it. And I've done like where, hey, I may be struggling for a month, and if I go and I spend this $10, $15, $20 on a meal, well, what if I bought a fractional share of Nike? What if I bought a fractional share of Nvidia? What if I bought a fractional share of the S&P 500? You know, and I know it's hard to think because you're hungry now, and when you eat, you're satisfied right away. And when you invest in the stock market, sometimes you don't get any satisfaction until later because you might be buying while things are going down. But the satisfaction in the long run is huge. And it's long term thinking that creates that generational wealth. And if we, as normal, average freaking Joes, can just do these things that help our next generation, starting IRAs for our minors, for our kids, getting them understanding how to invest in themselves, investing in the market little by little, and starting them really young. If you start a kid at 5 years old, starting a kid at even 10 years old, 15, it helps so much. And that's on us. The government's not going to do that. It's on us as parents, and it's on us as people. So really, that's my whole point of this channel, really, is to like try to influence people to do that. I am not a crazy successful investor. I feel like I have invested successfully. I have made some big mistakes. I've also had some big gains, but I am in no position to be telling people exactly what to do. But I do want to encourage people to start thinking long term and thinking for the future, because if you start investing now, the compounding interest adds up so much, and you will be able to not have to, when recessions hit, you'll it's not to say that people should be happy when the economy is going down, but everyone has heard those are the times where the rich get richer, right? When the poor people, the middle class, when they're having the hardest times, that is kind of when the rich are getting richer. Now, it doesn't mean that, hey, you need to put yourself in the position to take advantage of these times where other people can't. But also, why not? Put your kids in a position to not be bad people, but to be in a position to maybe own their own house, and then they can invest into the stock market while it's having a hard time, but they understand that the stock market will go back up. And right now it's just a hard time, but they have that money to invest rather than not setting them up for any savings, not setting them up for anything. And then when those hard times hit, they're one of the ones that are having a hard times and can't even make money, right? So that's just my 2 cents. Obviously, there's a lot more to parenting, right, and career wise and growing up and all that, right. But the point of it is to have that mindset. I already teach my kids about compounding interest and earning it, saving it, investing it, like just getting it in their heads. So that way, when they're teenagers in their 20s and stuff, they are already kind of on that train. Whereas some of us may have been in our 20s to 30s before we got into that train. I was I was in my 20s. When I graduated high school, I wasn't yet into it. I kind of understood a little bit of the stock market, but I really was not dipping too much into it. I was playing poker and hanging out, playing basketball and doing stuff like that. It was more in my 20s. I had my first kid at 26. That's when I really started getting more into it around, I was 24, 25. I'm 36 right now. So, yeah, I think if we can start our kids very young, and that's the generational wealth I talk about. It's not about, oh, let me hand over $1 billion. Let me hand over $1 million. No, what you need to hand over is a bill. Hand a bill over to your kid. When my kids grow up, I'm going to say, hey, you guys have to pay $50 a month to yourselves into an account and invest that money. You're going to hand over a bill. You're not going to hand over money. And then what they can do for their kids is the same thing, right? They can set them up maybe better, right? Hey, I'm going to set you up with an account with a bigger balance than what they were set up with, right? A starting point. But then when your kid grows up to 18, say, hey, I'm not going to provide this for you anymore. I've set you up. So when you're 65, when you start to retire in your 50s or 60s, whatever, you can start pulling against this. And but you need to teach responsibility, right? And so it's like, okay, well, now I'm handing this over to you, but it's still your responsibility to pay it every month. So I just think we need to be doing that more as a society. Just honestly, like, when we talk about like, oh, school taught us algebra, but not about finances. And it's like, before Google, yes. Before Google, 100%. But now we have Google. Every parent has access to financial information, financial literacy, financial education. We all do. ChatGPT, you can say, hey, what are the basics of financial literacy? What are the basics of learning the simple things of the stock market and this and that? Simplify it for me, please. We all have access to it. I understand that not everyone's going to have the Wi-Fi and the best computer. I understand resources aren't available to everybody, but the fact is, I've seen homeless people with cell phones. We all have access to this information, and there's no excuses. We should all be teaching our children and getting them out of that spot of being dependent on the government and being like, oh, well, hey, this is happening, right? Oh, and the market's going down, and that means everyone's losing their job, and I'm part of all this, right? You want them to be independent of all of that, and they can control their own destiny. I just feel like when you are teaching them about financial literacy, they don't have to depend on someone else trying to teach them that, right? You don't want to depend on the government to teach you finance. Why would they? And you got to think about that. A lot of people say, really the public school system is to create workers, not to create smart people and entrepreneurs, because it really isn't. So again, this is kind of a long rant right now, but my main point of this whole channel that I'm doing is really to get people encouraged to invest in themselves, invest in their kids, and start early. Because you start early, you will have so much more money. You will, I promise you. Just look it up. I'm going to put a link down for a compounding interest calculator. It's super simple. You put in how much money you have currently, right? Let's say you put $1,000 in. That means you have $1,000 in the stock market. Right now, you throw in $1,000. And then it says, what is how much you're going to be getting every year. Put 10%. And then how much are you going to be putting in every month? Up to you. Put in $10. Put in $10. and put in that you just put in $500 at that, whatever it is, and then put the amount of years that you're also going to save, right? And when you do a child, and you do, hey, I'm going to put in $500. I'm only going to invest $10 a month, but the kid is 5 years old, so they're going to be able to save for 50 years. Look at that number. Look at those numbers. Play around with the calculator. It's very encouraging because that's what I did. And I was like, whoa, hold on. That 5 year old that I was saving for and all that stuff, by the time they're 25, 30 years old, it's a good amount. But from when they go from 30 to 50, that amount increases so significantly. And that's where those early years really count, because that's where it was growing. You were already getting that rhythm going. And then as you got to that older spot, oh, light just died. When you get to that older spot, then it really accelerates, right? For a lot of us, if you don't start saving till your 30s, well, then it starts accelerating when you're in your 70s, and you're like, well, hold on, I need to start pulling it out. And when you start pulling money out of your account, now it's not growing. So if you start early, 5, 10 years old, and then it can accelerate earlier, then you can have that compounding interest, the power of compounding interest really work in your favor. So anyway, that's a long ass video. It's a long ass video, 28 minutes. So I hope you guys enjoyed it. Please give it a like and subscribe if you did. It really helps. And yeah, please don't forget, especially if you're a parent, to teach your kids. But for anybody, always remember to
Earn it, save it, invest it, buy low, sell high. I want assets, not liabilities, and you can count on compounded interest.